Welcome back. You're still watching Markets at Noon, and let us now try and gauge the market trend amidst volatility. Let's talk about the larger picture, the fundamentals of the market. And to help us on the same, we have Christy Mathai, Fund Manager, Equity Quantum AMC, joining with us. Christy, thank you so much for giving your time to ET Now. It's a pleasure talking to you this afternoon. Mansi, this side. My first question to you is on the texture of the market. There are a lot of factors which are impacting the market at present, be it the global factors, the domestic factors, but a clear trend or a trigger for the market to boost up is still missing. The earnings are also not trying to help the market at present. What's your short, medium, and longer term view on the market?
Right. Thanks for having me. So clearly, when we look at the markets at the current juncture, so we are in sort of a easing cycle, monetarily, if you were to look at it, the central bank is trying to revive up the credit growth, which is clearly lagging from past couple of quarters, and also to stimulate some sort of growth in the economy. Broadly, some of those can come through because you are sitting at a lower base versus last year. And but from a normalized perspective, it's nothing so great if you were to just look at the economic factors. There is this whole issue of tariffs. When if you were to just follow the last few months of the few days of news flow, so there have been several deals being cut. So looks like the peak uncertainty with respect to tariffs, even though the India part is not yet solved, remains at the back of the markets. So what's really the market's really looking at? So at the current juncture, given where valuations are, market is really looking at the earnings trend. And if you were to just look at some of the numbers that has come up, it seems like a mixed bag. So there is no certain acceleration that you see in the broader the company reported numbers. So from a short term, again, it's very difficult to say. It's all a function of flows. Possibly, if you were to see the FIs come back in a big way, you'll see some rally, but it's very difficult to call out. But from a medium and long term perspective, given where valuations are, our sense is it will all be driven by where you see the earnings trend. And in the absence, there is a general expectation of earnings to inch up. If that were not to come through, then we would be in a state of consolidation for some time. That's probably where we stand today.
All right, so with the expectation of earnings to inch up, we'll be seeing sectors and stock performing well. But then, let's talk about your investment philosophy, and via that, I really want to understand the current sectors on radar. Now, your investment philosophy says that, you buy stocks of companies at a minimum 25% of discount from their intrinsic or fair value. Now, having said that, these opportunities come when the market, especially in the short term, if it's fixated and, when there are disappointments. Looking at the current trajectory of the market, how are you placed in terms of sectors or the kind of companies that you're looking at, and especially the mid cap and small cap?
Sure. Yeah. So great question. So if you were to look at our philosophy, it's typically trying to buy underpriced companies which we think there is let's say 100 is supposed to be the intrinsic value. We would want to buy it at least 25% cheaper in our philosophy. So in a way, we run a value style here. So from that framework, if you were to look at the current juncture, not a lot of sectors fit into that bucket because many of those sectors are trading at its fair or above fair in terms of valuations. So if you were to look at we also look at, let's say, where should be a normalized earnings for a company should be, 2 years out, 2 to 3 years out. And then when we look at the current juncture, some of the sectors like IT, the current 2-year, 3-year earnings have been somewhere in the vicinity of mid-single digit, not more than that. But do we think this is where the normalized earnings should be? We think not. So we are sort of more exposed to that sector. Same is the case with banking, where we think the recent earnings print is not reflective of what their normalized earnings should be. Here in this case, the book value growth. We think those are opportunity sectors to get in. So this is also a market of relative valuation. So let's say in a great sector, you might have the top player would be perfectly priced, but when you move down to the second player or third player, relative to the valuation that the market accords, there could be some opportunities. Hence, we are present in some of those names. Maybe if you were to look at some of the spaces like insurance, AMCs, etc., we think those are some of the great opportunities that would come in. Now, from a relative, market cap segmentation, we think there is, from an investor, they should have exposure across the breadth. It is how you want and what percentage you want in terms of an exposure. So let's say if you were looking at small and mid, you have to be extremely selective at this juncture. And that's what we try and do, in some of our funds. We are very selective in terms of we're not exposed much to, let's say, the euphoric part of the markets, be it capital goods, defense, and so on and so forth. But we are trying to minimize the risk from that perspective. But at any point in time, you should have that perfect asset allocation, which would help you navigate these markets.
Christy, hi, Ankur this side. Recently, India-UK FTA has been signed, and I want to understand from you, will you be redrawing your strategies in the aftermath of this deal? And more importantly, you mentioned about India-US trade deal as well, which looks like round the corner. How you view it?
Yeah, see, from a, we just talked about the India-UK tariff deal. So, we just look from a market perspective, some of the sectors impacted, not really much, though it would be great from a economic standpoint, now some of the barriers are out of the way, but not much from a market perspective. Again, if you were to look at the US tariffs now, again, the exports that we have to US is minuscule compared to, the overall, import basket. So from that perspective, the few sectors which everybody knows and talks about is gems and jewelries. Pharma is a large sector from our vantage point. But we don't think there could be major impact. There is always room for error and front because this is all policy making. But given the generic nature of the, you're in a way trying to reduce the cost to the end consumer in US. So how much punitive action do you want to put in that sector? Some of the middlemen who are profiting quite a bit, they would be more exposed to some of these tariffs if there is, more pricing action on that front. So is one sector that could be on the radar given these deal front. And again, the whole IT services, which is an indirect impacted by this sector because the Fortune 500 companies of the world would possibly may not be spending so much on IT when there is so much of when the expectations are not very clear where to invest, how to invest. So when these deals conclude with major economies, we have seen a deal with Japan, we have seen a deal with the European Fund, possibly India in some way. So some of these, the issues with respect to how supply chains would revamp and how would it impact the Fortune 500 companies, thereby the spend, that uncertainty would decrease. So, in a way, IT services also is currently impacted, but incrementally we expect positivity coming out of when this whole dust settles.
Christy, thank you so much for joining with us and giving your views and analysis on the larger picture of the market. Thank you. Have a nice day and a great weekend to you.